History says that we're about to enter a weak spot in the stock market based on the overall presidential election theory. I've got that detail and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, right now it's we're in midterm season. I'm talking about the presidential election cycle. Why? Because history suggests we're about to hit some buying opportunities. History suggests we actually could see some weakness coming up. Now, let me before I get into that detail, let me just back up and tell you, no matter who's in office, which party, no matter what year, no matter what season within that year, it's a good time to be a long-term investor in stocks. That's without a doubt, that's what history shows, okay? As we get into it, they're all on average positive in the overall, in the stock market. So yes, could there be pockets of weakness? Yes, there is, and we're going to talk about that. But if you're a long-term investor, which this channel is for day traders, no, not so much. For savers that don't want to invest and just put their money in cash, yeah, this channel's for you as well. But mostly it's long-term investors. That's the approach that we take. That's the approach that fits best within your overall financial plan. And therefore, no matter, what area of the election cycle we're in, whether that even makes a difference on Wall Street, we're going to share in just a moment. But it's a good time to be a long-term investor, so have that perspective. But let's get into this presidential election cycle theory. And we're getting into this. Why? Because right now, we're in the 6 months leading up to the midterm elections. And if you take a look at this data here, this is the weakest time period in the overall election cycle. That's right. Most people think that it is during an election year that is the weakest for the stock market. That's not true. It's actually midterm election year, and actually the 6 months leading up to it. On average, going back to 1926, the stock market has averaged a 2.2% return during this time. That's average, so yeah, it certainly can be higher, but certainly can be lower to average such a small number. Now, that's where I would go back to tell you, as a long-term investor, this isn't something that should worry you or concern you, because still that on average is a positive time. But to go even further, that the 6 months leading up to a midterm election is typically weakest. It's the weakest 6 months, and it's also typically weakest when there's a when the Democratic Party's in the White House. And so on top of a negative first quarter for stocks, we're heading into what could be a tumultuous summer with the Federal Reserve trying to be more aggressive in their policy. We've still got to figure out what in the world is happening and what the outcome will be in the Russia-Ukraine conflict. And we've got to deal with inflation, okay? So on top of all of that, we've got what historically has been a weak seasonal time period. So to me, should be a good buying opportunity. Why do I say that? Because it's the 6 months following that are the very best in the presidential election cycle. That's right. Going from the midterms of November through April of the next year, that third year in someone's in the presidential term, that's the best time period, averaging over 13% in actual return during that time. So if we pan out then and take a look at the overall presidential election cycle theory, to me, guys, there is way more going on in what's driving Wall Street than who's in office and how long they've been in office. There really is. Now, I understand going into the going into midterms, that tends to be a time of uncertainty, and the markets don't like uncertainty. So this 6 months being traditionally weak, I think is logical and does make sense, okay? But most people think that the worst year in the stock market, based on what's happening with presidents, is during the election year, and that is not true. Take a look at the actual presidential election theory. It suggests that the first 2 years of someone's term, not the year that there's an election, but it's the first 2 years of someone's term that tend to be the weakest, and it's the second 2 years that tend to be the strongest. If you look here So after the election happens in November, and then someone takes office in January. From January for that first year, that tends to be on average the weakest, but it's still a 3% average return going back, what's that, almost 200 years. My goodness, guys. Second year, that midterm averages 4%. And like I said, if you dig into it, the 6 months leading up to the midterms tend to be the weakest out of this entire 4-year time period. It's that third year where there's optimism after the midterms. Also, that's a time when there's more clarity over, well, who's in office and what sort of control is there, and therefore what policies are being enacted. And so that tends to have the highest performance on average. And then the fourth year, which is the election year, not too shabby, okay? Still a 6% on average return, and that's the second highest of the 4 years of the presidential term. So what do you do with this information? Okay, so number one, if you're a long-term investor, and I hope that you are, then this doesn't change what you should be doing with your finances in the short term. Okay, this is more for expectation setting. We've been setting expectation with clients, and I've been sharing it here on the Wise Money Show really since last fall. Hey, once the Fed said, yeah, inflation's a problem, just brace yourself for some volatility. And I had a client ask me recently, well, by volatility, that's up and down, right? And yeah, actually, volatility during the days where there's a lot of negative volatility, where it's moving down the most, you see a lot of big spikes as well on the upside. Okay, that happens. I would brace yourself for some volatility. We saw it last fall. We certainly saw a negative first quarter, had a lot of volatility, and its potential based on this data that we could see more of it this year, especially when you combine it with what the Fed's doing, inflation, Russia, Ukraine, all of that. Certainly could be an eventful summer on Wall Street. So just brace yourself for that. That's the first thing. Second thing, if you've got new dollars that you're going to be investing, just sold a house and you made more on it and you don't need that to reinvest in the next house, something like that. Or you got a big commission or bonus, you've got new dollars that have never been invested, consider dollar cost averaging here, or looking for a time period where the stock market drops, maybe another 5-10% before having a lot of those dollars enter in. I personally like a dollar cost average approach so that you can buy in on some weak time periods that may, not for sure, may be coming this summer. Third, if you're needing some dollars, okay, if you're retiring soon, I was just talking to another advisor earlier this morning who was mentioning that a client was originally hoping to retire sometime in 2023. We did the math, did the planning. They're able to retire right now, so they're planning on doing so this summer. Well, if that's you, make sure that you're not taking too much risk, because you don't want to walk away from that paycheck and then all of a sudden have to start selling investments at depressed prices if we do see more volatility this summer. So that's the third thing that I would do. But then finally, I'd keep an open perspective, okay? This is historically what happens, but if you took a look at that presidential election cycle, there's a lot of seasons when it doesn't turn out to be true. If I'm looking at it right now, during the Trump administration, yes, it turned out to be true, but both terms in the Obama, both Obama terms, no, it didn't pan out. In the first term and the George W. Bush term, it didn't pan out. It didn't line up, where the first 2 years were underperforming and the last 2 were higher performing. It didn't work out. Okay, so this is based on a lot of data, historical trends, but it's certainly no assurance or guarantee that this is what we're going to see. So hold it with an open hand. Have it maybe set good expectations for you, or set expectations for you so you're not disappointed, but this shouldn't alter in a significant way your financial decisions. Work with your CFP. If you have new dollars that you need to be entering into the market, or you're looking at drawing some dollars out, now is a time period, great uncertainty, potential volatility ahead. Work with your CFP, craft the right plan. If you don't have a CFP on your team that can help you with that, you can contact one on my team. Find us online, Korhorn.com, that's Korhorn with K, wisemoneyshow.com, you can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.